All right, now to the statement of stockholders' equity, which is how did the owners invest in the company? And here again, we're looking at Apple. They did it by selling some stock. They sold $3 billion worth of stock. And then they had retained earnings, which is including net income of 53 billion, and they paid dividends of 11. So that were changed to retained earnings. Again, I'm going to ignore the other items for now because they're more technical. The basics I want you to look at are stock, profit, and dividends. And so we have explained the major changes in Apple, which are we sold a little stock, we made a lot of money, paid a fair amount of dividends. Okay. Profit versus cash. A firm could have good or a lot of income but poor cash flow. So here we have an example of how this might happen. You have a startup company, and on October 3rd, you sold $1 million to Google of a product that cost you $200,000. So right off the bat, oh, that sounds pretty good. I made $800,000, right? But they're going to pay you in 30 days. So what happens in October is you're going to report $1 million of revenue from Google on October 3rd. But from a cash flow standpoint, you don't get it until 30 days later, which is November 3rd. So from a profit standpoint, it's great. From a cash flow standpoint, it's not so great. Does that cause you a problem? Yeah, it causes you a problem because you have to pay rent and you have to pay your salaries to your employees. So this is an example where accrual basis is pretty accurate because it's reflecting the economic reality that you just had a very good month selling $1 million worth of product to Google. But cash flow is not so good because you're going to have to wait 30 days to get your receivable from Google, and life goes on. You have bills to pay. So this is the dilemma that finance people have to deal with, is the cash as well as the accrual basis aspects for a company. And when we look at Apple, let's look at their statement of cash flows. As you might imagine, it's extremely healthy. So we'll look at their three activities. They have operating, they made 83 billion. They have investing of 56, and they have financing activities negative 17 billion. And without looking at it too thoroughly, I can guess as what's going on. This is 81 because Apple is just very, very profitable. So they have high net income, not a lot of other stuff modifying that. So they made $81 billion in cash. What do they do with the cash? They're building factories and entering new lines of business, and they're buying stock and bond portfolios. That's why this is negative. Negative here isn't a bad thing. It means they're investing for future growth in physical plant or investing in securities to build a war chest for their next foray. Financing negative is negative bad? No, it means that they made so much money that they're paying off their debt and they're paying dividends or they're repurchasing stock, right? So this is an example, kind of a best case example of a company that just makes extraordinary amounts of money, and they still grew cash by $7 billion. So their ending cash position is $21 billion, right? So this is an example of a very powerful and successful company as reflected in cash flow. When we look at the relationship between the statement of cash flow and the income statement and balance sheet, this is a little bit of a complicated graph or graphic, but I'll go through it because when we look at it from enough angles, hopefully all of the pieces fit together in your mind. When we look at it from the standpoint of a statement of cash flows, we have information we get from the income statement, which is net income, because it's from running the business. And then we have changes in operating assets and liabilities. So these items in red represent what's reflected in the first grouping, the first activity, we call it, operating activities. Net income plus or minus changes in operating assets and liabilities. Second, investing. Nothing from the income statement goes there. But what does go there is any changes in the all non-operating assets. I described this in Apple's case as non-operating items like security purchases and non-operating assets and assets like building factories, right? And that's it, only this red. Financing, only the changes in long-term non-operating liabilities. So this would be long-term debt, bonds, and changes in equity. So the red shows that everything on the balance sheet, or the changes of everything on the balance sheet, ends up on the statement of cash flows, but not kind of as you might think logically, right? So we see that the statement of cash flow is a bridge between the income statement and balance sheet to help explain things. Warning, this could be confusing. So the hint is think, did I get cash or did I spend cash? So here let's look at assets and liabilities and look at what happens with cash flow. So let's say an asset goes down. So an example of an asset going down is we had $10 million in inventory and went down to $9 million. Question, does that mean we got cash or do we spend cash? We started with people owing us 10, they now owe us 9. That means they paid us $1 million. We got cash. So that's an example of as assets go down, we get cash, right? So let's do this one, accounts increase. Let's do inventory this time. Let's say we had $15 million in inventory, and then at the end of the year, we have $17 million in inventory. So did the asset go up or down? It went up, right? Account increases. Did that spend? Did we spend or did we get cash? Okay, we start with 15, we end it with 17. Oh, I have to buy $2 million more in inventory. So when I buy more inventory, I spent cash, right? So what you've just done is when accounts decrease on the assets, your cash flow increases. When accounts go up on your assets, your cash flow decreases because you had to spend money to buy the assets. So that's on the asset side. Liability, don't want to give you a headache, is the other way around. So when the accounts increase, you get cash. When accounts decrease, you spend cash. So here's an example. Let's say you owe nobody any money. And then you go to the bank and the bank loans you $100,000. So now your account, your bank loan increases to $100,000. Did you get cash or did you spend cash? Oh, of course, I got cash, right? The bank gave me $100,000 cash. I got cash. So when accounts increase, like a bank loan going up, you get cash. Next is, let's say a year from now, you had a $100,000 loan and you had a very good year. You paid off $75,000. So what happened was it went from 100 down to 25. So the account decreased. Did you spend cash or get cash? Oh, easy. I spent cash, right? I have to use my cash to pay down $75,000. So I use cash to pay back my loan. So that's how this works. So this little chart to many people looks a little confusing, but if you think through it, hopefully it makes more sense. So when we look at the operating activities part of the statement of cash flow, it uses this dynamic. We start with net income, and then we add back depreciation because that's a non-cash item. Then we subtract for increases in current assets and add decreases in current assets, right? All we're doing here with the pluses and minuses is implementing what we do here. So that's how cash flow moves, and why, in a way, this is why people don't like the statement, because it's a little non-intuitive unless you really kind of get your head around it. Okay. This is another way to depict it. Same thing, I'm just trying different angles to see what kind of clicks in your head, but I'm not going to repeat this because I used these examples earlier, right? So you can look at this slide at your leisure. All right, now we're on learning objective 2, which is linkages between the four financial statements. So let me ask you to think about this for a moment. How do these statements, or do they, link to the balance sheet? So 1, 2, and 3. How do these statements link to the balance sheet? Ideally, tell me the accounts that link. At this point, you might be getting a little confused, right? So let's show you the answer. Answer. The linkages look like this. This is an account level description of what we saw earlier in Module 1, Chapter 1. How we had balance sheet at the beginning, balance sheet at the end, and in the middle we had income statement, cash flow, and shareholders' equity. You may or may not remember that simplified schematic. But these are the anchors, balance sheets. as of certain dates, as of September 27th, 2014, as of September 26, 2015, right? 1 year. So there's a linkage from the income statement to the shareholders' equity. Then the shareholders' equity has contributed capital, retained earnings, and shareholders' equity beginning, and then it's capturing all the changes in more stock being sold or stock being repurchased, any dividends that are paid out to shareholders, and any other changes in the equity, and all those flow into the balance sheet, right? So statement of shareholders' equity explains, as I've said earlier, each of the categories, what changed during the year. So the linkage is very direct. Then the statement of cash flow, we start with beginning cash. We have a net change of cash and an ending cash. This one's the simplest, right? Beginning cash plus net changes equals ending cash. So you can see that the balance sheets tie in some way to the three statements that cover the period, in this case, of 1 year for Apple. All right, so that's the linkages.